Hey everyone, welcome to another edition of the Buddy Study Group, and we are continuing on with our study hall series. Today we've covered short-term care, we've covered traditional, we've covered hybrid. I think it's time to talk a little bit about annuity long-term care. And this market has some heat coming off of it, and it has for quite a while. We've seen a lot of new developments lately, some pretty earth-shattering new developments in the case of some of the newer products, but there are some tried and true things to like about annuity long-term care that have been there this whole time, and I think it bears repeating, discussing on this call because I think they go underrated, underused. Um, Even though this market has a good bit of attention on it, I think we still need to see folks recommending using annuity long-term care a bit more where they can. So, discussion today is really going to be just kind of going through high level what's to like about annuity long-term care. We'll take a look at some carriers, talk about some of the products in the space. Um, I'm really going to stick to some of the main 7702B long-term care products that we are using. But I'll call on some people and eventually on the room to talk about how they're using annuity long-term care, what products they're using if they weren't mentioned, and a few other things. So it's going to be a good one today. What is the main appeal of annuity long-term care, guys? I think there's a couple of pieces. I think number one, light underwriting is one of the biggest draws for annuity long-term care. Um, Annuity long-term care can be a case saver. So you actually see that directly at the carrier level with One America. One America does an excellent job at this. If you have a client that's declined for asset care, in many cases, you don't get that decline email without getting an offer for annuity care, some sort of offer of annuity care, be it uh, even if it's annuity care one, no COB, you're still ending up with an offer. The client is able to leave with something. So it can really be a case saver in those situations. Um, Most of the time, we're dealing with what we would call simplified issue underwriting page and a half of knockout questions, no exams, generally a phone interview max for the underwriting process once you've applied. So I think that easy, streamlined process is always something to, see as valuable. The ability to get somebody true long-term care coverage with minimal underwriting, especially if they can't qualify for option A, B, or C, makes annuity long-term care products a great alternative. I think there's maybe a limiting factor there that not all people will financially qualify for an annuity long-term care product. It's generally got to be somebody who is affluent, able to make some sort of single premium payment um, to really be drawn to an annuity long-term care product. But the underwriting is definitely something that I want to make sure is highlighted. And it may not be just a pure approved decline, right? Companies like For for example, they underwrite for is your long-term care going to be on a doubler or a tripler, right? Depending on your answers to the underwriting questions. So, um, y-
Jason, can I butt in real
yeah,
quick?
yeah, go for
I
it.
think it's also kind of interesting that last year they simplified their process further. They saw a big spike in sales activity, and it was a win-win for the carrier because a lot of the activity was also old annuities with gains getting exchanged for the annuity care product with just the five questions. Even without the COB, like you said, you're getting tax leverage,
Right.
and it created a win because now the clients are getting a long-term care plan from funds that they weren't planning to use, for guaranteed income. So I think it's just really smart, taking advantage of the natural market there and creating even almost like a low risk scenario for the carrier at the same time.
Yeah, I think people, I always recommend diversifying, looking at as many products as possible to fit financial, client preference, and underwriting needs. But I think you could realistically make a practice out of being an annuity long-term care specialist because I believe that the point you just touched on, the Pension Protection Act, that is like 1A, right? With light underwriting for why to truly consider annuity long-term care and integrating it into your practice.
And it's been around
So
since 2010. I mean, and people still don't know about it.
it's amazing how many people I will mention this to. How many annuity carriers, Phyllis, have we talked to personally who have given us presentations um, where we've kind of educated them on the Pension Protection Act for the first time. It's pretty amazing that this
Yeah.
program has been around for so long, offers such a huge benefit, and is still really underpenetrated as far as the market goes. So, for those of you who are hearing this for the first time, don't be discouraged by that, but you have a great opportunity in front of you. So, the Pension Protection Act says that if you 1035 exchange an annuity, let's just use an example of an annuity with significant gains, in
Non-qualified, non-qualified.
non-qualified, correct, yep, into a 7702B long-term care annuity hybrid plan. If you use the money from that long-term care annuity for long-term care benefit, what would have been taxable as gain in the annuity you are exchanging will instead be received tax-free. Again, requires you to use it for long-term care, but you have to think about many of the situations that people find themselves in from a financial planning perspective. Needs change over time. There are a lot of vehicles out there that were originally earmarked for a specific purpose, and that purpose has been fulfilled in some other way, and you've kind of just got an annuity that's sitting there that doesn't really have or serve its purpose in full anymore. And I think the opportunity there is if you have clients like that who have annuities with significant gain in them, they've let them sit for a while and accumulate, and they need long-term care. They've yet to plan for long-term care. I mean, what a double whammy to be able to satisfy long-term care benefit for this client, repurpose the annuity. And oh, by the way, if we end up needing long-term care, we have a huge tax mitigation scenario potentially for this client. I think especially in the long-term care world, we are always looking for a way to check multiple boxes for a client, right? Um, Hybrid life long-term care sales have taken off because they check multiple boxes for a client. Annuity long-term care does the same thing. And if you are exchanging an annuity, it's found premium dollars, right? The client doesn't have to reach further into their pocket to do this long-term care planning. It's it's a path of much less resistance to be able to take an existing annuity, give it a new purpose that the client feels comfortable with, you know, again, mitigate that potential tax scenario. You just check so many boxes. And I think it's something that if you are meeting with new clients regularly and you are doing a fact-finding process and you are not asking about assets like this, do you have any sort of annuities? Do you have any sort of existing life insurance? Things like that. You are missing opportunities to bring to the surface found money. And now you're not telling a client with no long-term care plan that they have to fork over an annual recurring premium or monthly premium or a large single premium. You are working with assets they already have and repurposing them, right? I think that's one of the easiest ways to get a yes, especially if the vehicle you are exchanging does not serve its purpose any longer. So that is one thing. If you are learning about the Pension Protection Act for the first time, I encourage you to make that a part of your process. If you know about it and you're not asking about it as much, or you're not outwardly looking for those opportunities, they are all over. The annuity market, beyond just long-term care annuities, has been hot for a long time. There are a lot of existing annuities out there. There's a ton of annuity value out there in the market. This is not to say you should, rip an annuity away that is for a certain goal that's still needed, that's performing well for the client, but you really have the opportunity to kind of put them on a new track that they really need to solve. So that's kind of my soapbox about the PPA. I think it's probably the number one reason to look at long-term care annuities. But beyond that, beyond underwriting flexibility, beyond the ability to kind of fund efficiently, beyond the tax advantages, there are opportunities to even do joint coverage with joint annuities, right? It's not just a single life opportunity, right? If you have couples who jointly own an annuity, there's another opportunity there for you. And we'll talk about this a little bit more. There is some inflation growth with annuity long-term care products, but I think in many cases it leaves something to be desired. You're not going to get really high-powered inflation protection like you get with other products in many cases. Um, but it is still something to consider at the end of the day. Again, I think this is for folks who have the capacity to make a single premium, who need to do long-term care planning, who have an existing annuity. Um, I think gender value tends to be a little bit closer than, say, um, traditional and hybrid plans. Um, And I'm trying to think if there's anything else I should really mention from a high level. If anybody else has anything, I think those who still have a need for like accumulation and still have a need for that guaranteed income stream, regardless of if it's for long-term care or not, um, you probably look at other products. This is for the purpose of long-term care first and foremost, even though they are annuities that can generate income. Um, Anybody have any questions, comments, thoughts on that?
Uh, Jason,
Yeah,
this is Pete. I'm a newbie here, and I'm just absorbing and learning as I go. But what you said sounds like a fascinating tactic. Can you 1035 a life insurance policy into the same thing?
not that I am aware of. It has to
Yeah.
be an
So
exist.
yeah, and there's basically a chart in the Pension Protection Act that basically says you can do life to life exchanges. So you can do
Mhm.
life to a life LTC rider. You can do annuity to annuity, and you can do life to annuity.
Do annuity to
You
life.
can't do annuity to life.
Hmm.
You can also do life or annuity to traditional long-term care, standalone long-term care. So there's a lot of like combinations, but they won't let you take the annuity gains and fund a life contract. That's the one big limitation.
No, but
Great
if you
question.
if you have a life insurance with a high cash value, can you convert it into one of these things?
To a life, you can do it to a life long-term care hybrid, yes,
Oh,
without
okay.
tax with the 1035 exchange. But caveat is those life products are more underwritten than the annuity products are.
Got it.
So typically we have clients that are tend to be, above 65, 70 years old when they have that higher cash value in their life product,
Mhm.
but they won't qualify for the life long-term care product or it'll be prohibitively expensive. Whereas annuity products, as you get older, get to be better value
Right.
as they give you kind of immediate leverage when you make the transition. So just annuities are a better fit on the buying side of the equation.
Yeah,
Got it.
that's another huge highlight is that annuity long-term care products tend to have some of the highest ceilings as far as their age ranges, going up to 80, in some cases 85. Um, I still think at a certain age, there's very limited product options. But going up to 80, 85 in limited cases is still a pretty high ceiling to be able to get somebody insured. And when coupled with a simplified underwriting process, is a pretty good match. Um, so just like the life hybrid market, we have different chassis of annuities that we can have these plans on. And one of the big ones um, is fixed index annuities. And Phyllis here, who's on the call with us, has really championed the existing FIA solution that we have out there, has been campaigning for it for years and years before it existed. It was just a twinkle in some actuary's eye. And we now have the Equitrust Bridge product. There's a lot to like about Equitrust Bridge. First and foremost, we talk about light underwriting. Equitrust Bridge is a guaranteed issue plan for annuity long-term care. 7702B long-term care, Pension Protection Act eligible. It has a lot of what many professionals on the market were looking for. And Phyllis, I was wondering if you could give us a quick 5 to 10 minutes on Bridge, though I know we could talk for an hour and a half on the product.
Planning on 2 hours. Yes,
We'll
yes,
release a director's cut. How's that?
okay, all right. Yeah, so I started using annuities in 2015 for people who are uninsurable because there were several, a few anyway, maybe 3 at that point, that would pay double the income for 5 years as long as you still needed care. And then it would go back to whatever the regular lifetime income was. Now, those were regular fixed index annuities. And that meant when the money came out, you'd be taxed on the gain, but people could put qualified money in them too. And then of course they'd be taxed on the whole thing. Generally I was using non-qualified money, and that 5 years was guaranteed. Well, then they started changing, and it was said, no, it'll pay double as long as there's cash value. Well, that might be a year or two, it really lost the sizzle. There is one today that guarantees the 5 years investors. But then, things started. I thought to myself, I don't understand. And I started like the Aflac duck, but nobody would listen. But I said, I don't understand why a fixed index annuity can't be filed as a 7702B and just use the HIPAA triggers, because the trigger in those older annuities was needing help with 2 ADLs. And there was no cognitive, just the ADL help. And I said, if you file those HIPAA triggers, surely you could come up with a product where the benefits would be tax-free. So yeah, I harped and harped and harped and talked and talked. And I mean, was in New York City talking to some of these big annuity people, and they just kind of blew me off. So, but ultimately Bridge was born, and I talked to the actuary that designed it like 3 different times. I don't know, a long time. So Bridge is so wonderful. I pulled up a few things to show you here. Well, let me just give you the high level before I even show you anything. Okay, with Bridge, it is a fixed index annuity. I like to choose the S&P 500. There's several choices, like 5. I like the S&P 500, point to point, 1 year, and then there's an S&P participation. Don't go off on any of those other indexes. So you put your money in, and then I will share this because I have to show you the chart. Okay, you put your money in, and there are 5 questions. And depending on, you could actually be in a nursing home, but it's going to ask you 5 screening questions, like, are you in a facility? You currently need help? Do you use a wheelchair, motorcycle? No, motorized scooter, stair lift. Some people probably do. Let's see. Big things: heart attack, bypass, COPD, kidney failure, cancer, metastatic cancer, or you're on disability. All right. If you can answer those questions all no, this is what happens. You go to the next level, and they do a video interview. As an agent, we can't even put in an application until this video interview is done, and you can schedule it right there on the website. So preferred, that what they look at, they don't get medical records, none of that. They look at how you are mobile, cognitively not impaired, that kind of thing. They ask the person to get up, turn around. They don't have to dance, but they do have to show that they are fully mobile and that they're with it. And then they would get this top category. So depending on the age, 55, I wish it went to younger, they would get 325% of whatever premium they put in. Now, somebody over here, secure, the lowest one, that could be somebody in a nursing home. I mean, nobody's turned down. So worst case scenario is 125% of the premium. Best case is 325% of the premium. And then that is vested over 4 years before the full amount comes in. But from day one, the long-term care account grows at 2% compound for the earlier of filing a claim or 20 years. Now, on the other side, you've got this accumulation account. If that ever exceeds the long-term care account, it will true up so that the person would have that much money. Now, what I didn't think about was wellness credits. There are, if you follow the personalized wellness plan that they make for you, then you get more money added to your account. There is no elimination period. We beat that horse to death last week. And so it's cash, which I love. You can use it without turning in receipts or filing claims. So that's a big deal. Now, what about the fees? Okay, I want to, and when you have a claim, then it's paid out over 5 years, 60 months. Okay, now the fees. The very first year, it's 1% of the premium. That's the first year only. That's it. And then the other fee is based on what they call the net amount at risk. And that took me a while to figure that out. That is the difference between the long-term care account and the accumulation account. Well, as that accumulation account grows, as the person gets lower, the charges become less as the person gets over, because there's not that big of a difference between the accumulation and the long-term care account. So that is, it's guaranteed money, and of course, you can use the money any way you want to. So what have I forgotten?
Well, we did have a question about the ratings, and I know Equitrust is, started out as, I believe, B plus, and with a couple of different ratings agencies has been upgraded to an A minus. I believe Standard and Poor's was one of them. I think they're still due for a ratings review from a couple of other ratings firms coming up here. Let me see if I can find the most up-to-date ratings that we have.
It's Fitch assigns an A minus. That was
Yeah. Jason, I'll put it in the chat for you guys.
Okay, perfect.
I just asked AI.
You just ask AI.
Yeah, so I do totally understand where you're coming from. If one of the ratings agencies is below an A, given your BGA brokerage agreement, whatever it may be, you're not able to write. Totally understand that. That's why we're rooting for Bridge. This is a product that can serve so many different people in so many different ways. Again, another 7702B long-term care product that is Pension Protection Act eligible. We're excited to see what the future holds for Bridge. And
states, that would be helpful, I think.
yes.
You
So the only states they are not available in at present, I believe, are the 4 original partnership states, actually. New York, California, Indiana, and Connecticut.
That makes it easy to remember.
Yeah. So if you can remember those off the top of your head, number 1, you're a nerd. Number 2, you know where Equitrust Bridge is available and is not.
And their fixed interest rate, y'all, is 5%. If you wanted to put some of the money in that, you could. So, and you can change it every year, whatever the allocation is. I also think we need to mention that if care is not needed, the money, the family or the beneficiary, whoever, would pay tax on the gain if care is not needed and they
Correct.
value of the account. Okay. But if it's for long-term care, then that switch over, like Jason's talking about, that gain will not be taxed.
Yep. And I do see that we have Ramona on the call and was talking through kind of what do we call this market, just as I said, our endless nomenclature neurosis. Um, I don't know if we'll ever kind of settle that debate, but one of the things that seeing Ramona in the chat reminded me of is we have different chassis on annuity long-term care products. We have some products out there also kind of pertinent to our discussion in the annuity market that will use the term long-term care in describing their benefits, but you really want to make sure that you are reading the contract about what that long-term care benefit entails. What are the benefit triggers? What's really going to happen at claim time? Because I think a lot of what Ramona was talking about in the life long-term care hybrid market really applies to the same discussion. And Phyllis, I know you deal with a lot of sort of non 7702 long-term care adjacent or long-term care annuities. Can you kind of give us an idea, just given your experience, of how that market works and what we should watch out for? I think that'll help everybody a lot.
Yes, I can. But let's just cover the three tax-free ones,
Yeah,
77. Yeah, bridge, annuity care, one
correct.
American, or care, guarantee income, whatever. So, but you can be turned down, completely turned down on annuity care or for care,
Correct.
which will not turn you down. So that's a cool thing.
And I'll also mention we have heard rumors that there are one or two new carriers that are entering the 7702B annuity space. So I do expect to see more coming to market from some big carriers, A-rated carriers
I
soon.
can like half let a cat out of the bag there because we did have Alan Gregoire on, who's head of underwriting at Nationwide. He did say there are plans in the works for Nationwide to come out with an annuity long-term care solution. That's a big one to look out for. I mean, Nationwide is kind of a market leader in the hybrid life long-term care space, the extension rider space, and they're showing a lot of dedication to the long-term care market. Not only has Care Matters been successful for a while, but a couple of years ago added Care Matters together, and now they're really filling out their portfolio by adding an annuity long-term care product. And I asked Alan about this when he was on the study group, and he was really envisioning it the same way as One America kind of uses annuity care. Not only is it there to provide a strong 7702B long-term care annuity, but also it's a great downhill and case saver for folks who get declined for Care Matters or Care Matters Together. Take a look at the annuity option and see if that will fit and see if you can be accepted. But Phyllis, to your point, you will likely be able to be turned down for that product as well.
Well, and I talked to Nationwide first because they are so strong in fixed index annuities. It just seemed like a natural outgrowth for them, whatever. So the next best one would be the North American Secure Horizon Plus. And the plus is the ADL account, activities of daily living account. And you do have to, there's a 1.2, I think it is, fee for this. It's called a retirement rider. And what happens there is after the charges, okay, whatever the net accumulation value is, it's double that goes into the ADL account. And then when one has a claim, that account is paid out. It's annuitized, actually. It's paid out over 7 years guaranteed, and it's paid out with an exclusion ratio because it is annuitized. So you would just pay tax on the gain, that portion, unless you put qualified money in, which is allowed. So it's paid out over 7 years. Now, if the person dies in the middle of that 7 years or somewhere, the beneficiary still gets the remaining payments in that 7 years. So the tricky part to look out for on these, and it's the bane of my existence, is, those 0 years when there's, you'll hear the word zero is your hero. Well, that's true if it's a no fee product. But if there is a charge, then those charges will come out no matter what. And if there's not any gain, then the people can lose money due to the charges. So I will mention, I just found one annuity, and it's really new and it's really different. And it's a Nassau product, and it's called Athos. And they will lock in 90% of the highest day in the term, which it could be a 1 year, it could be a 3 year. The problem with point to point is, you start over here and then a year later over here. Well, if over here is lower than where you started, that's a 0. But in the meantime of that year, there might have been some growth. Okay. It's going to lock in 90% of that, which will help people not have the 0 years. And then it also does participation starting at 48%, and it grows for every year there's a positive, the participation grows. So, the market is evolving, because I think a lot of people are complaining because of these 0 years.
Yeah. Phyllis, let me also add something. This FIA market is growing really fast as a whole. So by extension, the ADL doubler market is growing. And that's what we call them, as ADL doublers, because you do pay tax on the gains. It's not tax-free long-term care. So that's the big disadvantage of not having you filed this 7702B, like Phyllis was saying. The other big thing that, Phyllis, you taught us is that most of them only cover facility care. So you have to look for the contract definitions that also cover home care if that's important for your client, which, 75% of the time,
It's going to be.
care starts at home.
Yeah. The way is it will just say the trigger is needing help with 2 activities of daily living. That's the way you'll know. It won't say facility only. Okay. That's how you know.
Yeah. And Phyllis, why do you think there's a reservation on the carrier side to, um, file their products as 7702B long-term care, as opposed to kind of skirting calling it an ADL account?
I think it has not been on the horizon, and they've overlooked it. And now we're starting to see articles like Morningstar put out one a few weeks ago that said long-term care is the most overlooked thing in retirement planning. Well, as this is bubbling up, and with the baby boomers and all the adult children who are caregivers, finally demand is coming up. It's like getting an elephant to notice a grasshopper. Okay.
Right.
So now, there you go. So now they're finally noticing us and seeing that there are people who will buy these products, supply and demand. And I think that's why we're seeing them, and they have to be friendlier than they were to really make it work. Yeah.
Yeah. And Jason, I'll give you a couple of carrier reasons, right? Because there is some friction there. They have to file the product 7702B with not only the life division of the Department of Insurance, but also the health division, the LTC division. So you have 2 sets of regulators, and there's a lot of boxes you have to check when you file an LTC product, that, the required forms and the third-party lapse notifications, and you have to have the optional 5% rider, which may or may not make sense, but you have to offer it by regulation. So there are some pragmatic, practical reasons. Plus, the agents have to get licensed for LTCi, which we all think is a good thing. It's not like a huge barrier to entry, but it's enough of a barrier to get some agents or advisors to say, I'm not going to pay attention to it. And that's a real practical limitation in growth. So the same reason why life carriers had chronic illness riders and not long-term care riders, you're seeing that this is the equivalent for the annuity space.
Right. Yeah. And I think in competitive
But
scenarios,
Phyllis,
okay,
right.
You need qualified money, right?
Oh, say it again. You broke up a little bit.
Oh, we need to address the qualified money. Lori's question.
Yeah.
Okay.
Yeah.
The only one now, well, okay, the one that I was talking about, the North American FIA, Secure Horizon, you can put qualified money in that. But as far as our 7702B products, the only one you can is One America on their annuity care. But here's what happens. You put the money in, it actually goes into an annuity, and then it feeds over a period of 10 years. So you're spreading the tax over 10 years in order to get the benefits tax free. However, there's like a 25% charge on that. Okay. That's the problem there. Whereas you could take that money, put it in a 10-year certain annuity, and then have it go in, that way you could do that. But
And I believe that's Annuity Care 1 only,
mhm,
if I'm not mistaken, or what we traditionally know as Annuity Care 2 is non-qualified dollars only.
mhm.
Um, so there are options out there. They are a bit limited. There is a lot of, I will say, there's a lot of engineering that goes into those types of cases. So you really want to make sure you've got a good carrier rep or somebody in advanced planning that you can talk to as you're going through those cases if you do find yourself in one of those cases. Um, yeah,
Answer Dave Ray's questions. Uh,
let's
what when you say nationwide can as well, we're talking about the 7702B products, okay, not the regular annuities, because yes, you can do qualified money all day long. And when you say a lot of advisors believe in self-funding, of course they do. But to me, here's my analogy on that. Trying to self-insure for long-term care is like trying to outrun a forest fire. And my dad was in forestry, and he would tell you right now that you can't do that. So that's why they had these asbestos tents to protect themselves if that happened. So this whole thing about throwing money into an annuity and hoping that in 30 years that they will have a big enough gain to pay for care, I don't think that's taking into account what care can cost in 20 or 30 years. It might be 25,000 a month, 30,000 a month, depending on where they are. 24/7 today is 300,000, and the high net worth people think they're going to have 24/7. That could be $1 million in 20 years for a 3-year claim. So and if it's a couple, it could be 2 million. So there you go. I mean, that's I'm really on my soapbox right now about advisors telling people they can self-insure. Sorry.
it's okay. Doesn't take much to get me on that soapbox too. Yeah, and Mark shared a piece from Lincoln talking about just sales ideas for annuities in general. Um, and just the more and more I get exposed to more of the market, just going through this discussion, um, getting familiar with annuities and helping clients understand where they are with their current annuity, being able to conduct reviews will really help the long-term care side of your practice because in the sales idea in Lincoln, they actually talk about funding a hybrid life long-term care policy from proceeds from an annuity. Again, if not earmarked for, other financial goals or immediate needs already, that can also be sort of a suitable practice, right? Annuities are going to pay a guaranteed income stream. It could do something like fund a 10-pay product as well. So I just think the crossover between annuity experts and long-term care specialists runs pretty deep just like with other markets. So I encourage you all to start paying a bit more attention to this market if you haven't yet. There's a lot of sales opportunities that come from it.
Jason, also want to address something Ramona or Romeo had mentioned in the chat with the medically underwritten SPIA,
Yeah.
which we were excited to see kind of make its return and then its demise, if you will, its
Yeah.
exit again. So having a product for those that are currently in a care situation that can kind of put in a lump sum and provide them with a guaranteed income, being already in care. I do think there's a market for that, but carriers, I think, haven't seen the sales yet, and so it takes a long time to get that up and running. So we'll see. We'll see if a carrier kind of tries to enter the fray there again. But right now, I'm not aware of a product like that. I've heard that Mutual of Omaha has a rider on their product or something you can check, but I haven't seen it in practice. Romeo's shaking his head no. So it doesn't seem like any carrier is really pushing that concept right now.
It's a smoker's deal. If you smoke, they make you like 1 year older. It's no big deal.
Oh, okay. So
What was Federated Life? Weren't they trying to do that, Mark, a couple of
which
years ago?
one?
Life, wasn't that
Federal
it?
Life? Federal Life, yeah, they're the ones that came into the market and then pulled the product um, out of the market, which is I think about a year ago now.
I spent some time with the underwriters in England, where it's very, very popular, when they were going to have Genworth bring it in, but then Genworth all of a sudden said, "Nope, not going to do it."
Yeah.
Yeah. So, but I would say, what I always say is, go where the market's at today, and you have a lot of solutions for annuities for your clients. Even the bridge that Phyllis talked about is guaranteed issue. So I wouldn't necessarily use it in a situation where someone's in care because there's a vesting period on
Yes.
it. But if they have like a long, duration, it could be viable to work with them as well because again, you're always going to get like, that bonus, whatever it might be on that age chart, 120%. There may be a 1035 exchange opportunity where you're getting leverage just from the taxable gains and you're helping solve something that underwritten SPIA was trying to solve. So I don't think it's out of the realm of possibility there.
Dementia cases, yeah. You know it's going to be a long haul. Sure.
I
Yeah.
think just first and foremost, these are super creative long-term care plans that are only going to get more creative as carriers start to raise their awareness around this market, understand the amount of volume that's in this market, and want to play a part in it. That's going to create competition. That's going to create differentiation. And I just see this market continuing to innovate over the years. I'm really surprised that the advent of Bridge didn't get others from the industry a little more immediately involved, but we're still kind of waiting to see the ripple effects there as it's relatively new, right?
Yeah, I think they are. It's just it takes 3 to 5 years.
Right.
You see it. So
And we're right about there. So I don't think anybody started the first day that Bridge came out with a plan, but things headed in a positive direction for them. I think there's a lot of watchful waiting from some of the competition to see, hey, how are things going for them? And given that their financial ratings are continuing to go up, I think that will again signal um, a lot more to come in this industry. So that's why we got to have a study hall every year on it, guys. Let's see.
yeah,
Ramona
like
says,
thanks Ramona for sharing the market intel. She's got a great pulse of the market. 8 insurers looking at doing market assessments on this annuity long-term care space. So that's a good sign. And obviously the one or two that we discussed that we think are poised to enter right away.
right. And I think from a financial planning perspective, we are at a point in the American workforce where the vast minority of people are pensioned workers, right? So annuities are helping to sort of fill that gap and provide a guaranteed income stream to folks who, um, right now are looking at, say, like a 401k plan. There's the ability to annuitize from certain 401k or retirement plans. So given that, I think the as the size of the annuity market grows, there's going to be more opportunities for you to help clients review, make sure they're in the right spot, making the right decision, and see if you can utilize the Pension Protection Act because that tax benefit is just monumental. I really, really think, don't get me started again, but I really think it's completely underused. And those of us who have met with carriers with ADL accounts as opposed to 7702B long-term care, the wholesalers who are selling those products have no idea the Pension Protection Act exists in some cases. And we're like, well, go run it up the flagpole, right? And they're like, I for sure will. Um,
Jason, also one other thing you reminded me of too is I do think there's going to be this movement for more annuities and 401ks. Remember, this was enabled through the first Trump tax bill,
Right.
right, around 2017. And it takes time to build those products, but now you're going to start to see annuities as an option on the menu
Right.
that you can choose from along with your mutual funds. You can put your money into an annuity so that, Jason, exactly what you said, you can build your own personal pension. Adding long-term care to those annuities can make sense, although inside of a qualified vehicle, it already has some tax advantages that you don't necessarily get a
Right.
double dip on. But I do think, you have a couple of ways to use those funds more effectively. Even if you like accumulate the money until age 65 and then you move it over as a lump sum into one of these options that we're talking about. So I think the carriers are going to get pretty creative with how to use annuities. And then obviously the ADL doublers might just be attached to it, right? Because that's just a part of the product.
Yeah. And Ramona, you do make a good point. Financial suitability can be a decline for Equitrust Bridge. Um, I think when we use guaranteed issue, and there's been some hotly kind of contested thinking over this. We tend to think of it more toward the medical space and the actual health underwriting as opposed to financial suitability. Um, I totally understand where you're coming from, though. 100%. I think you, like a lot of us here on this call, are crusaders for if we name something, it has to be consistent and it has to be perfectly descriptive of what this phrase is ascribing, right? And
Guaranteed issue to me means health insurance. That's my orientation.
Yeah,
yeah,
every sale has to be suitable. That's just
yeah,
like kind of table stakes for buying a product in general.
Rona's
If
right.
I can interject and ask the question
yeah.
to those on the call. You guys started off with it at the beginning. This is Ramona. It's just a mystery on why these products haven't sold more. And then you guys gave an example of One America's an extraordinary spike in sales just with the base, just for the tax leverage,
Right.
for the tax preferential treatment. So it's absolutely remarkable. And that I bet has caught the attention of a number of competitors. Just that alone, it's a lot less risk for the insurer. But there's got to be another reason why these haven't taken off more, particularly since the process is simpler than the hybrid life. And so I don't know the answer. I honestly don't know. But sometimes when I don't know the answer, I feel like there's a liar's box. And could it be compensation? I don't know.
Well, Ramona, I'll give you a different distribution reason. I don't think it's compensation. I think it's that you have annuity specialists, you have long-term
Yep.
care specialists. It's very hard to find somebody that knows both sides of that. And it really takes a dedicated like marketing push, like from a BGA. I think that's where a lot of those sales came from.
Well, yeah,
Bridge that
exactly.
gap.
It wasn't even just the BGA, it was One America as well, actually
The other
pushing
wholesalers did a great
they
job
were
of pushing it out.
they were
Yeah.
pushing a campaign for annuity care. They were, I believe, offering in some cases instant approval for, 1035s into base only. So that was the carrier actually taking a stand and saying, hey, these need to sell more, even if we gotta, put an incentive out there. Um, it's the right time. We just need the right message to be able to do it. Um, and yeah, I kind of agree with Mark. There are annuity specialists and there are long-term care specialists. They don't talk to each other enough. Just like, go ahead, Phyllis.
This my whole idea, and this is what I was making my sales pitch on. Bridge is a bridge. I didn't know they were going to name it that. Okay. I was saying, okay, a fixed index annuity filed as a 7702B is a bridge to get us into the billions of dollars
Mm,
and the millions of agents selling annuities. So Ramona, that to me, but did I get a lot of traction? No, it's like, oh, we don't care about long-term care. Well, now the demand, it's finally happening. It's finally happening. I'm about usually 10 years ahead of something. It's finally happening. But that's looked at. If we're going to get it into the annuity space, it's got to be a fixed index annuity with tax-free benefits for long-term care.
that's cool. I didn't know that. The
Yeah.
the whole bridge naming convention. That's pretty cool.
going to name the product. I just kept saying this would be a bridge. This would be the bridge, from the long-term care insurance industry into the annuity industry.
I
And Ramon,
also
that addresses Ramona's naming concerns, right? So every product like it should be called Bridge, right?
oh, we're never gonna
I
solve it,
think
guys.
that as the market kind of matures, that most of the innovation is going to occur in the annuity space. It seems like there's more leeway for them to kind of move parts around and work with the cost of the products to them versus traditional long-term care. They're working with premium and risk. They really can't, change the growth within the product or
Yeah.
allocations and things. And do you think that's why it's occurring in those products, is that they do have a little more freedom to kind of go in and shuffle things around?
I think there's a lot more competition.
Yep.
So there's a lot more annuity carriers out there. And if you want to differentiate yourself, you got to add some unique features. And this is one of those features that I think they can add that makes them competitive, but still allows them to focus on their core. So to me, that's really the key is a growing market. And to Phyllis's point, there's demand that's growing the market, but supply really is what generates, I think, the market in the insurance industry because it's a risk first industry. So Matt, to your point, yes, they're going to be more comfortable on the risk, but they are going to dip their toe in first, which is why we have the ADL doublers that cover facility only. They're a little bit more strict and limiting.
Hmm.
And the ones that want to push the envelope have to get more comfortable and have that internal, you know, claims expertise, underwriting expertise that goes beyond. Annuities typically aren't underwritten, so they don't necessarily naturally have that expertise unless they have a strong life division and they're bringing that into the development process. So it's just these different worlds colliding, right? At the end of the day, it creates a more complex situation that takes longer to bring things to market, but it's going
It
to happen.
does seem it's happening more on that side of the products than the traditional side is, they just kind of have kept it on as usual. And a lot of the focus seems to be, on the hybrid side.
Yeah.
The annuities, see, they can do more things because they don't, you're using your own money first. I mean, they don't have that level of risk as our traditional products. But I do want to emphasize something for y'all, and boy, am I learning it the hard way. Stay away from the crazy indices like Barclays, or I don't know, there's so many. Just go with what they're doing on S&P, and if it's not attractive, don't deal with that product. Okay, like now there's some that have 8.5 or 10% caps on the S&P or higher participation rates. Do that, because these crazy indices and they'll tell you all kinds of things that's in them, but they haven't worked for me.
I mean, if we're really and truly having our first objective as long-term care, I think there is something to be said about playing it a little bit safer with the indices, given that we're trying to really foster security in this part of the client's life. But I think like the discussion in general, I really like, markets are going to come crashing together. Long-term care is really coming into its moment. Like Phyllis said, the elephant is realizing and reacting to the grasshopper. We're going to see a lot more demand in the long-term care industry. It's just going to continue to happen. Washington Cares Act was kind of the first major ballast. We're going to see more. And I think these worlds will collide more. I think this is also a message to just network, get in touch with specific experts of specific areas. It's great to have somebody who's an annuity specialist. It's great for annuity specialists to know a long-term care specialist. It's great for them to teach each other. It's great for them to come into each other's side of the market every once in a while. Long-term care specialists take the annuity suitability training, annuity specialists take the long-term care and do your 4 and 8 hours. I mean, there's going to be tons of cross-sell opportunities as if there isn't already. And I think the more versatile, the more nimble you can be, whether it being have somebody to refer to or taking that knowledge on for yourself if you're hungry, if you're early on in your career. I think noticing these kind of market movements and really putting as much as you can into your knowledge to create new specialties is really a good way to go.
And also, the biggest objection from annuity producers, they hate underwriting of any kind. So that's what makes bridge to me so attractive, because it's still going to be a guaranteed issue no matter what. And the different kind of underwriting, video underwriting versus medical records and all that stuff, they hate that stuff. So it's all bridge needs, I think, would be a limited pay. A 5 pay, a 10, preferably a 10 pay. Man, if
Yeah.
they we
The
could
market in general, Phyllis, I think is missing limited pay. I think there's tons of opportunity there. And like Ramona said, do we have guaranteed issue? Do we have a real wide range of suitability without being able to qualify more people financially in that, not everybody has the capacity to make a single premium. I agree.
Yeah, I think it will happen too, just like on the life hybrid side, right? It used to be all single pay there too.
Hard to say that, Mark, and
Yeah.
it as people demanded it. Yeah. Hey, I took an app today and I noticed on the personal worksheet it said, "Do you think you could afford this product if you have a 50% rate increase?" Remember how it always said 20%? Now it's 50%.
Yep. Love it. I thought this was a great conversation. Um, You know, I expected it to be a little bit more structured. I'm glad it wasn't. We were able to cover all sorts of topics related to 7702B or not to be. That is the question. We talked about, a bunch of different carriers. We talked about what to look out for. We talked about the sales opportunities. Is there anything else that you would like covered before we wrap it today? And keep in mind, we got 60 seconds.
You think annuity producers look at these differently than what they're normally writing things for? As far as lenses go, like a long-term care specialist is using legislation and taxes, and annuity producers are looking at income and growth. And by the time we're writing this stuff, we're not looking at trying to grow it. We're trying to, do an exchange and get some other leverage based on legislation.
I think you nailed it. I think that's like the biggest like distance as far as perception between annuity specialists and long-term care specialists when they're looking at long-term care focused annuities. It is a long-term care focused product. The accumulation takes a back seat for annuity specialists who are looking at trying to get the best rate for accumulation for at the end of the day the best guaranteed income stream they could possibly get at for a client. Um, you know, there's different ways each get lost in the weeds. I think that's creating the biggest kind of cognitive dissonance right now is where's the accumulation? Well, if you don't have long-term care as an objective, there are plenty of better places you could go for a purely accumulation-centric annuity. But for long-term care, the amount of leverage you can get on the long-term care value, especially given limited underwriting or guaranteed issue, not accessible to a lot of people. So,
Yeah, Matt, we're seeing annuity specialists adding long-term care as that fourth objective. Like the Annuity Giants group, Tracy Lonesbury, who's been
mhm.
on our study group, they're including that as a big tier in addition to income growth. Now I'm forgetting the third one, but yeah, it's definitely that fourth tier for sure.
And bridge has the accumulation. See, that's what again is so cool.
You
So
get both. Yeah.
we're dabbling bait in front of them.
Right. Yeah. It's about you know, we will continue to pull everybody toward the middle. I mean, we'll never be able to give both extreme sides of the fence the best of both worlds, but we're getting as close as we have ever gotten, right? And that's a reason to be optimistic about the market. These two markets becoming aware of each other and learning to work with each other is going to create so many good outcomes for clients all over the country. And it's just a matter of time.
We
So.
need the financial advisors on board. Hello, hello, hello.
And they're in the middle of all of us, right? They're in the middle of all of us specialists. So um, that's a completely different soapbox. I do at least 1 to 2 sessions on that every single year. Um, this kind of education is what helps get it done, folks, right? So if you have financial professionals that you're close with that you want to, um, you know, take advantage of the education, this is open to all financial professionals. If you got a particularly good recording, you can shoot that off to somebody you really respect or want to work with and say, I thought you'd find this discussion interesting. So
40.
Right. Um, so I really appreciate it. We're 2 minutes over, but happy we had the extra conversation. Thank you, Phyllis. Thank you, everyone who asked questions, added their comments. You guys make this study group what it is. I just kind of sit here and look 20 years old, as Phyllis said, and facilitate a lot of the conversation. But you guys really make it what it is. So appreciate you all very much. Have a great rest of your week, and we'll talk to you this time next week.